Hey, I'm Zeke.
And I'm Brian.
And you're watching Two Guys Talking Home Buy.
Hey everybody, thanks for joining our show. If you haven't been here before, what this show is all about is helping as many renters as possible to become first-time home owners. So we want to help as many renters as possible to buy their first homes, and not just to buy the first home, but to actually take that piece of real estate and use it as an important part of their financial strategy. So we cover everything. We go from the beginning of the process, choosing a realtor, choosing a loan officer, all the way through to the end of escrow when you get your keys. So we cover it all, and specifically today what we're going to cover
is all about home loan programs. Hey everyone, I'm Zeke. I'm the social media director here at Showcase Agency, and I'm also planning to purchase my first piece of real estate this year. I have a lot of questions. I don't have that much, experience in the whole real estate industry, and Brian on the other hand does. So I hope to get a lot of my questions here answered today.
Yeah. And my name's Brian. I'm the co-founder and president of Showcase Agency. And we're a real estate company and a mortgage company. So we help people to buy and sell homes, and we also help them to get the financing for the home. So my wife and I founded the company in 2017. And Karen, my wife Karen, she has been a licensed realtor since 2001. And I've been a licensed loan officer since 2005. And so between the two of us, we've got 38 years of combined experience. And we thought it would be fun to get in front of the camera with Zeke and listen and answer his questions. And if you're thinking about buying your first home, hopefully you'll find this show and this episode really helpful for you. And if you'll hang around till the end, we also have a free gift for you. We can let you know how you can download a free copy of our new beginner's guide to first-time home buying. So without further ado,
awesome. Let me get to my first question.
Let's hear what that first question is.
All right. What are the requirements to qualify for a conventional loan?
Great question. So there's conventional loans are going to have a minimum credit score requirement of a 620 mid credit score. So you got three credit scores. Whichever one falls into the middle is the one that is going to be used by the lender. And if that score is a 620 or higher, then you're eligible for a conventional loan. But here's the thing, when you are between like a 620 to a 680 on a conventional loan, 620 to 680 credit score on the conventional loan, honestly, you're probably better off with an FHA loan, because with the conventional loan, the interest rate is going to be higher. Pretty high at like 620 to 680 score, but also the mortgage insurance is what's going to be really high. So those two factors. So you can go to we can go down to a 620, but if you're between 620 and 680, the FHA loan is probably going to make more sense for you. Now there is an exception to that. Conventional loans, which are either Fannie Mae or Freddie Mac, those are like abbreviations for what they really stand for. But they actually have a program where the interest rate and the mortgage insurance is very, very good at a low credit score, like a 620 credit score. But the catch on that is that there's income limits. So if you're, let's see, in Orange County, for example, most of Orange County, you're probably looking at the income limit is like $86,000. And if you're in like San Bernardino or Riverside County, the income limit's like $77,500. So if you had a 620 score and you had a 3% down payment, and you fit into that income category or below, then a conventional loan, either what's called a home possible or a home ready loan would be the best, would be a good loan for you.
Awesome. That's awesome.
And the other qualification, so usually when you're looking at a loan, you're looking at the down payment, the credit score requirement, and the debt to income ratio. So most of your conventional programs are going to have a debt to income ratio, a cap, at 50%. So that just simply means if you made $7,000 per month a gross income before your taxes and deductions come out, if you made $7,000 a month, half of that, 50% of that's $3,500. So that would be your maximum amount allowed for your mortgage, the property taxes, the insurance, and also whatever other debts that you have. So like car payments, credit cards, things like that. So 50% is kind of your number with conventional loans.
Wow, 50%. So that in that example, if you made over if you spent over 3,500, you wouldn't qualify for the conventional loan because your debt to income would be maxed out.
Yeah, exactly. So let's stick with that same example. Let's say your gross income $7,000, 50% of that is $3,500. If you had a $500 car payment, now we've knocked the available house payment down to $3,000. Does that make sense?
Okay.
And then let's say that you had some credit card debt and you had, like $150 a month that went towards minimum payments on credit cards. You would take that $150 off of that $3,000. Now you're down to $2,850, and that would be what's called your housing payment. So your housing payment is going to be your mortgage, which includes the principal and the interest. It's called P&I sometimes. And it's also going to include mortgage insurance. If you've got mortgage insurance, it's also going to include your property taxes and your homeowner's insurance. And then if you were buying a property that also had a HOA, then that homeowners association, then that monthly homeowners association fee goes into the housing payment. And if you were purchasing a property that had like a solar lease, so they got solar panels, but they're on a lease program. Whatever that lease payment is, that goes into the housing ratio as well. And we don't see this a lot, but if you were in an area that is a flood zone based on the government agency FEMA, if they said it's a flood zone, you're going to have flood insurance, and so that would be in your housing payment. So those are all the things in the housing payment. Your housing payment plus all your minimum monthly debts, that all has to fit into that 50% box. Yeah.
Awesome.
Yeah.
Awesome. Thanks for answering.
So the more debt that you have, the less home you can purchase, and so sometimes it makes sense to pay off some debt before you purchase, just so you can purchase more.
Would a way around that be increase your down payment?
Yeah. So you could increase your down payment, but increasing your down payment really doesn't make a huge difference unless you're increasing it quite a bit. So if you were going from say like 3% down now to 10% down or 15 or 20% down, that's going to make a difference. But
it's a huge jump.
But it's a big jump, yeah. But to go from like 3 to 5 or from 5 to 7 is not going to make much of a difference.
Gotcha. Thanks for answering that.
Yeah, no worries. Great question. What's next?
You. Yeah, what are the requirements to qualify for a FHA loan?
Okay, so FHA is going to be a lot easier to qualify for, and the reason why is they go down to a 580 credit score. Well, actually they go lower, but most lenders are going to cap it around like 580. So 580 is the number that we're always talking about. So 580 and up, so it's a lower credit score. It also allows for 57% debt to income ratio. So instead of 50, it's now 57%. So you can squeeze more. Sometimes you can get approved for more with an FHA loan instead of a conventional loan, just because of that debt ratio being higher. So 580 credit score, you got to have 57% DTI. And with FHA, you also have what's called a housing DTI or a front-end DTI. So they look at two numbers, and you have to fit into both of those. The 57%, like we were talking about, where it's your housing payment plus your minimum payments on your debts. So there's also a front end ratio. So your front end ratio is your housing ratio. And that is just simply everything that fits into that housing category that I talked about earlier, the HOA, the principal and interest, the mortgage insurance, property taxes, all that stuff. That has, on an FHA loan, that has to fit into 47% of your gross income. So FHA has two DTIs you have to fit into, the 47% front and the 57% back. So if you've got a 580 score or higher and you have, you can fit into that debt to income ratio, and then you have their minimum down payment, which is 3.5%, then you're set. That, and FHA is typically better if your credit score is lower, say like, typically like 660 or less. A lot of times you're going to look at FHA as being a better deal instead of a conventional loan.
Awesome. Just a pop-up question. So let's say you have like a 800 score, 830. Mm-hmm. Could that increase your debt to income?
No, great question. It does not affect your debt to income. But what it does help you with is it helps you to get a better interest rate, and it helps you to get a better price on mortgage insurance. And by doing that, that's going to bring your payment down, and that's going to help you to qualify for more. So the credit score helps, but it doesn't like change the DTI from being 50 to now it's like 55 or anything. But what it does do is it lowers all your costs, and so now the loan itself costs less and you can purchase more.
Awesome. Thanks for answering that.
Yeah, great question.
Thank you. Which programs have the best rates?
Okay, and that's a little bit of a trick question. And the reason I'll tell you that, and there's one thing I want to say before I go too far, because you were asking like, what does it take to get a conventional loan? What does it take to get an FHA loan? Yes. You're also going to have to provide whatever the income documentation is required for the program. So let's say that you work for someone else and you get a W-2 at the end of the year, then that W-2 income is what's used for qualifying. If you're self-employed, you might be on a Schedule C, or you might have a separate entity where you have a corporate tax return, and so it's calculated off of your corporate tax return. But the point I want to get to here is it's either calculated off of your tax returns or your W-2s. That's pretty much it. You can't go off of your bank statements. You can't go off of 1099. 1099 is what you get if you're like a gig contractor. There's a lot of gig workers and freelance workers now, because you got Uber, you got DoorDash, you got all these different things, and you're getting a 1099 from the company for that. So there's programs for that, and we can talk about them later, but I just forgot to point out that with conventional and FHA, the income qualification is going to be your traditional income qualification, where you've got to have a W-2 job or self-employed. If you are getting 1099s, it's possible that you could still go with a conventional or an FHA loan, but you're not going to be able to go off of like your bank statements, like the deposits in your bank statements and things like that. So I just wanted to point that out real quick.
Thank you.
As far as what loans have the best interest rates, again, it's a little bit of a trick question, because if I've got if I'm going with an FHA, if I'm going with a conventional loan right now, I might be around about 4.25%. That's kind of like a common rate with good credit. So 4.25%. On the FHA side, the rate's going to be like, a good bit lower, like 3.5, 3.75. But the difference is the mortgage insurance. So with FHA, your mortgage insurance is typically 0.85. Now, if you're getting a high balance loan, which means it's above the conforming limit, but within the FHA county limit, if you're getting a high balance loan, that's going to have mortgage insurance of like 1.05%. So what that means is you take the 1.05, you add it to that 3.5, and so now your effective rate is 4.55. Did you follow me on that? We added the 105.
Kind of, yeah.
Okay, so your interest rate on FHA is say 3.5. If you went with the high balance and you put the minimum down, now your mortgage insurance is 1.05. So you add those two together, and when you add them together, that's what's called your effective rate. So like in this example, we're adding that 1.05 to the say 3.5. Now we're at 4.55.
Gotcha.
Yeah.
Gotcha.
But on all your paperwork, it would say 3.5.
Okay.
Now on the flip side, and that's just for the high balance. If we're talking about it's falling within the conforming limit for the county, then the mortgage insurance is probably going to be about 0.85. So now you would take the 0.85, you would add that to your 3.5, and now you're at 4.35. So those are your effective rates, and that's really important because on the FHA loans, the mortgage insurance stays on the loan for the entire length of the loan, unless you were to put down a bigger down payment, like 10%. But if you put down the minimum down payment, you're going to be looking at that loan, that mortgage insurance being on the loan for the life of the loan. Now on conventional, the thing that's cool about conventional loans is that the mortgage insurance falls off eventually. So it's usually somewhere around like the 2-3 year mark, could be up to 5 years, but it's probably going to be more like 2 to 3 years here in California. And when that mortgage insurance falls off, your payment goes down. And so that's why a lot of times people like conventional loans, even though the interest rate is higher, because the mortgage insurance might be like, if you had excellent credit, your mortgage insurance might be like 0.46 or it might be like 0.6. So now you're talking about, yeah, those numbers together, that's your effective rate, but the mortgage insurance falls off.
Gotcha.
Later on.
Gotcha.
The other thing, when you talk about having a low rate, it's not just the interest rate, but it's also whatever credit or cost that goes along with that rate. So FHA loans have more of a credit than the conventional loan. So that's another reason that a person might go with an FHA loan instead of conventional, even if they qualify for conventional. And that's because they're getting a bigger lender credit with FHA, and then they can take that credit and apply it to the down payment, or not down payment, I'm sorry, you can apply it to your closing costs, your prepaid, your impounds, all that kind of stuff.
Awesome.
Yeah.
Awesome. That's great. Thanks for
Does
that.
that answer it? Or?
Yes.
Okay.
Very good. So what's the down payment assistant program?
Okay, down payment assistance programs, they kind of fall into, well, I was going to say they fall into 3 buckets, but there's probably more buckets than that. But let's just use 3 as an example. There's down payment assistance programs where the assistance has to be paid back. So let's say you get 6% of assistance on a $500,000 home, that's $30,000. A lot of times you won't make a payment on that $30,000, but if you refinance the house or if you sell the house, then that $30,000 gets repaid. So that's a really common program. That's how this program called CalHAFA works that we offer. A lot of people offer it, but we offer it as well. And it's put together by California Housing and Finance Authority. And that's how the program works. They give you the money to get into the house, but they set up a second lien and sometimes even a third lien to cover that whole 6%. And then, like I said, you refinance or you sell and you pay it back. So that's one type. The second type is the type that actually is forgiven. And it's usually forgiven over time. So it's usually forgiven like a third in the first year, another third in the second year, and then if you're in the house for 3 years, at the end of that third year, the whole thing that was used for down payment assistance is forgiven. So that's another type of program. And then a third type of bucket that I was talking about would be local programs. So some cities, some counties will actually have grants. They're typically grants. And so they're literally just giving you the money. And it never has to be repaid, and there's typically like no waiting period, where you got to wait for it to be forgiven or anything like that. So those are like your three down payment assistance buckets, I guess they could fall into. Does
Awesome.
that make sense?
Yeah,
or?
yeah, perfect.
Okay.
And then what's the debt to income?
So just in general, with down payment assistance, a lot of times you're going to have a little bit lower debt to income. So on a conventional loan, instead of 50% DTI, you might be maxed out at like 45% DTI. Sometimes the programs will have a higher credit score requirement, like you might be getting an FHA loan, but that down payment assistance program might have a 680 minimum credit score or a 660 minimum credit score. So you could go FHA with a 580 credit score, or you could go down payment assistance FHA, but have to go with a higher score.
Gotcha.
So a lot of times they'll require a little bit higher credit score. They'll cut the DTI a little bit. And sometimes they may have some other qualifications, like on the California Housing and Finance, unless they've changed it recently, you cannot have a non-occupying co-borrower. So a lot of times when people are buying their first home, they might have an additional person on the loan that's not even going to live in the house. It's just somebody that's just helping them to qualify for the loan. They're just co-signing for the loan. And like the CalHAFA program does not allow that. So if that's, so if that's part of what you need, then that program wouldn't work, for you.
Gotcha.
Yeah.
Gotcha.
But you're going to tend to have, some minor restrictions like that. And you might even run into those, not on FHA, but on conventional, you might even run into some income limits, like we talked about earlier, where if your income is over 86,000 in Orange or LA, or if you were, I think it was, what was my number, 77,000 if you're in Riverside or San Bernardino or whatever. If you're above those numbers, you're not going to qualify for some of the down payment assistance that's conventional.
Perfect.
Yeah.
Thanks for answering that.
Yeah, sure.
My next question is...
And I was just going to say that that money with the city and the county can be hard to get sometimes. And not every city, not every county offers any kind of down payment assistance. And sometimes it's gone before you ever even know about it.
Okay, gotcha.
Yeah.
Awesome. And then what's the percentage that you need on an investment property program?
So if you were going to buy an investment property with a conventional loan, you're looking at anywhere from like 20 to 25% down. Technically, the program goes up. The program allows you to do 15% down, but you're really not going to get an approval with 15% down. So you're looking at 20%. If you can go 25% down, it's going to give you a much better. Rate and than if you went with 20% down.
Awesome.
So that's conventional. FHA, they don't allow for investment properties. It's not a program that's supposed to be for you to use to build up, your real estate portfolio. So the only way that you can do FHA as an investment property is if you were buying like a multi-unit, like a 2-unit, and you were going to live in one unit and rent out the other. Or if you were buying a 4-unit and you were going to live in one and rent out the other 3. So that's how you could do it with an FHA loan. VA doesn't allow for investment property either.
Wow, I didn't know that.
Yeah.
Thanks for answering that. And then what's the down payment like the percentage wise on bank statement program?
Bank statement programs, so let me tell you what bank statement programs are first. So bank statement programs are very, very popular with business owners, very popular with, like we talked about, the gig economy with Uber and Lyft and DoorDash and all those guys. A lot of times you've got more income coming in than it looks like you've got when you file your taxes, So if you can go off of your deposits into your bank account and use that for qualifying, that's what a bank statement program is. It's allowing you to qualify off of your bank deposits. So we've got that out of the way. Some programs, most programs are going to let you get in with 10%.
10%. Okay.
Yeah.
On both.
On bank statement.
Awesome. With FHA and conventional.
Well, see, FHA and conventional, those aren't bank statement programs.
Oh, okay.
So that's a great question. I'm glad you brought that up. So that's exactly what I was talking about earlier, is only going to be W-2s and tax returns. So if you don't qualify off of your W-2 or your tax return, then you're not going to fit into FHA or conventional. So that's why people go to a bank statement program sometimes, because the bank statement program has a higher rate to it. It might be like right now they're probably like around 5.25 to probably like 5.75, but there's no mortgage insurance. So that's we were talking about the effective rate earlier. There's nothing to add in. There's no mortgage insurance.
Gotcha.
Yeah. So that's how the bank statement programs work, and typically 10% down. But if your credit score is lower, they might require you to have 15% down.
Gotcha. Perfect. Going back to the conventional loans, what would you say some of the pros would be?
Pros of the conventional loan, like I was saying earlier, the mortgage insurance, drops off. Another thing with the conventional loan is you don't have what's called upfront mortgage insurance premium. That's upfront mortgage insurance premium is on FHA loans, and then VA loans has a similar fee called a VA funding fee. But what that is on FHA is 1.75% of the loan amount. So if you put 3.5% down, they're going to come back and eat 1.75% of it by financing in an additional fee. So you don't pay that fee out of pocket, but it's financed into the loan. So that's another reason conventional is good, because it does not have that upfront mortgage insurance premium. Another thing that's cool with conventional is, and this isn't always the best option for some people, but there's a program where you can have the mortgage insurance included in the interest rate. So they increase the interest rate a little bit, but there's no mortgage insurance. The downside of that one is if you're going to be in the house for a long time, you want the mortgage insurance to fall off. But if you're only planning to keep the house for a shorter period of time, it's called lender paid mortgage insurance, where it's rolled into the rate. Sometimes that's a better option. And you're not going to get that kind of option on FHA. You're only going to get it on conventional.
Wow.
So that, and also too on conventional, they can be a little less restrictive on requiring paperwork and things like that. So sometimes if you've got the qualifications, the credit score and the income, a lot of times conventional is the best way to go.
Cool.
Yeah.
Thanks for that.
Sure.
What would you say some of the pros are for FHA?
FHA, higher debt to income, lower credit score requirement. You're not going to get beat up as bad if you've got low credit. You're still going to get a decent rate. Another advantage is you can do what's called a streamline. So once you purchase the house, about 6 to 7 months later, you're eligible to do what's called a streamlined loan. So if the interest rates were to go down from the time that you bought the house until that 6 or 7 month period, you could go back and refinance that loan without having to do another appraisal. And also the upfront mortgage insurance premium that I was talking about that you paid, that 1.75% that's financed, you get a credit for that, what isn't used, which is like the majority of it, because you've only been in the loan for 6 or 7 months. So that's another advantage. It makes it easier to get a lower rate a little bit later. And the credit, the lender credit, like I was talking about, if you need money to cover your closing cost, FHA a lot of times is a good route because they have bigger lender credits.
Awesome.
Yeah.
Thanks for that.
Sure.
Next question is, how long do you need to be in the military to qualify for a VA loan?
Okay. I don't think you have to be in there very long. And I know that's not like a definite answer, but from what I've seen, once a person has made it through like boot camp and they've been stationed somewhere, they're probably eligible. But it's usually going to be, they're going to get what's called a certificate of eligibility, and that's what determines if they're eligible. So pretty much once they're in the military, then
Awesome.
then they're good.
And then that's the one with 0% down.
Yeah,
right?
yeah. So it could be. Depends on the loan amount. If you're going with a really, really big loan amount or a really big purchase price, you would have to bring in some money. But if you're staying, around the numbers, like Orange County, the high balance limit's $980,000, so or in some change. So, those are, if you're dealing with those kind of numbers, the VA is going to let you go 0%. One of the downsides with VA could be that upfront funding fee that I was talking about. It's 2.25%, I believe, so it's kind of high. But if you've been declared disabled, even just any disability at all with the military, then that fee is waived. So you don't pay that fee. The other big advantage with VA, besides the 0%, is that you don't have any mortgage insurance. So you get these really low rates like FHA with these big lender credits for the closing costs and stuff, but you're not stuck with that mortgage insurance.
That's cool.
Yeah, so that's the best part about it, probably.
Awesome.
Or one of the best parts.
Leading up to my final question is, how many years of bank statements would you need to qualify for a bank statement program?
Great question. There's programs that use 24 months, 12 months, 2 months, and 1 month. Now, when you start having only like 1 or 2 months, then you're going to see that the qualifications are harder. You might have to have a higher credit score, you might have to bring in more down payment or whatever. So most people doing a bank statement program would probably go with 12 months or 24 months to get the best. Now the reason that you go with something shorter would be if you go out a few months and your deposits don't look too good, then they're not going to help you. But if you've had a lot of great deposits last month or last 2 months, now all of a sudden if you've got the down payment and the credit, you can get approved.
Thanks for sharing that.
Bank statements, yeah.
Wow, I didn't even know that they would allow 1 month or 2 months.
Yeah.
But
You got to be really well qualified with credit and
debt to income,
debt to
right?
income, yeah, that
All
kind of stuff. Yeah.
Awesome.
Yeah.
Well, that pretty much
But
wraps up all my
a-
questions.
Well, cool. I want to tell you about great questions, by the way. I
Thank
want
you.
to tell you about a few other programs since that's what we're talking about here. So I'm just going to run through them, and if you got any questions, let me know.
Okay.
We kind of covered a lot of these already. We covered all of the down payment assistance. The one type of conventional loan and FHA loan that we did not talk about is what's called a renovation loan, and we've covered this before in some other content. But with the renovation loan, you're actually getting money not just to purchase the house, but also to renovate the house. And you can, the Fannie Mae program allows you to even add what's called an ADU, which is basically like a separate unit in the back that you can rent out or whatever you want to do. So they're super, super popular now. So you can even add one. FHA has a program called the 203K, and that program does the same thing. It gives you money to purchase the house and then also money for the renovations. And so that's really nice because a lot of people, when they, especially first-time buyers, they might be looking at a house that's on the lower price point, and sometimes at the lower price point, that means that it hasn't been updated, recently. And if you're buying a house and you want it to look, newer instead of look like it's from, really, really long time ago, you're probably going to want to do floors and paint, and you might want to rip out the kitchen and the bathrooms and all that kind of stuff. And you can do all that kind of stuff with the conventional renovation programs. Fannie and Freddie offer them, and then also with the 203K.
That's cool.
Yeah, so I wanted to bring that up. And then there's a bunch of other programs out there. And since this is all about loan programs, I just wanted to bring them up, even though these aren't really like the most common programs that somebody's going to use if they're a first-time home buyer. So, but I just wanted to bring them up. There's also programs where you can purchase a home without any income documentation, as long as you have a big enough down payment and you have a an excellent credit score. Those are called stated programs. They're also the kind of programs that were the cause of a lot of problems when we had this global financial crash back in
okay.
07.
08 or 07.
08, yeah. So you've got stated programs. That's just basically where you say, hey, I make this amount of money, but there's really nothing that backs that up. We talked about bank statements. There's also programs now, because there are so many people that are getting 1099s because of these different gig jobs. So there's programs now that are specifically where they just go specifically off the 1099, and that can help somebody to qualify. There's I-10 programs, so that's somebody who doesn't have a social security number, but they've got, I forget what I-10 stands for, taxpayer identification, individual taxpayer identification number, that's what it stands for.
There you go.
So I-10, that's somebody that's here in the United States legally, but they don't have a social security number. So there's programs for that. There's also foreign national programs. This would be somebody that actually lives out of country, but they want to buy a home here. Maybe they don't even have U.S. credit. Maybe all their credit is like, because when we talk about Equifax, Experian, and TransUnion, that's the U.S. credit scoring system. It has nothing to do outside of the U.S. Everybody has their own system. So foreign national, that's something program. There's programs called hard money. What hard money is typically a short-term loan. So you're getting a loan, and you see hard money a lot of times with investors that are flipping properties, where they use this hard money. That's just what it's called. It tends to have a higher interest rate, but they go with an interest-only payment, which keeps your costs down. And you're probably only going to have that loan for 3-4 months at the most, because what you're doing is you're purchasing the house, you're renovating the house, and then you're selling it. So you're flipping it.
Right, but those 3 or 4 months, you're doing payments, right? So I can imagine those payments must be huge.
Well, you're doing, so that's why a lot of times you're doing interest-only payments.
Oh, right, you mentioned that.
Yeah,
Sorry.
You're doing interest-only, because while you're in that renovation stage, before you can sell the house, you're renovating it. One thing you want to do is you want to keep that time as short as possible, because every month is costing you something. You got to make that mortgage payment. If taxes are coming due, you got to pay the property taxes, different things. So you want to get out of that renovation period as quick as possible, and you want to keep your cost as low during that time. So that's why the interest-only loan is really good in that situation. So that's hard money. It helps you to buy the house, but you're not going to keep the loan because you're going to sell the house. There's also programs called asset depletion, and that's where you don't really have any income, or you don't have enough income to qualify, but you have a lot of assets. You have a lot of money in the bank, in investments, retirement accounts, stuff like that. And there's a way that the lender will look at that and will calculate like how long that money will last and what they can use that money for as far as your qualifications. So that's asset depletion. So if you didn't have the income, but you had a whole lot of assets, that's what you would go with. There's also construction to permanent loans. That's where you get a loan to build a house. And then once the house is built, the construction loan is converted into a traditional mortgage. Because sometimes what you do is the other option is that you get a loan to do the construction, and then once all that stuff is complete, then you have to get a new loan for the mortgage. So construction to perm just puts it all into one
mortgage.
Yeah, so you don't have to redo it.
Oh,
yeah,
okay.
So you don't have to redo it. And then there's also jumbo loans. Now again, all of these that we just covered are not like your typical first-time home buyer loans, but since we're talking about loans, I wanted to cover them all. Jumbo is anything that's over the county limit. So in Orange County, it's 970, 800. So if you were at 970, 801, that'd be a jumbo. Now you wouldn't want to do a jumbo. You'd want to go a little lower. Mm-hmm. But if you're in Riverside, your limit's 647, 200. So anything over 647, 200 in Riverside or San Bernardino would be considered a jumbo.
Awesome.
Yeah. So
awesome.
That's it.
I guess that's it.
So very cool.
But Lots of great information. Thanks for, answering all my questions.
Yeah, absolutely. Great questions.
Thank you.
You got a viewer question
Yes,
too?
I do. Let me go over to my viewer question. So I don't qualify for the loan alone or with my husband. Can I add a third person to the loan and then take them off after? And is there a limit to how many people I can add to the loan?
Cool. Great question. Thanks for the question. There's a few things in there. Can you add another person to the loan? Well, yes, you can. But it's going to depend on, is that person going to live in the house or are they not going to live in the house? And we covered a little bit of this earlier. So if they're going to live in the house, they're considered to be an occupying co-borrower. And if they're not going to live in the house, they're considered a non-occupying co-borrower. Now, conventional loans and FHA loans are going to allow for a non-occupying co-borrower. But if you go into like a down payment assistance program, there might be a restriction on that. So that person could add someone to the loan application if they are going to live there, and if they're not going to live there, it's going to depend on the program. So yes, they could add somebody. Now they asked about, can I take them off later? In order to take somebody off of the loan, you actually have to refinance. So there's two parts to the house. There's the loan, and then there's the title. The loan is the note, the mortgage note, and then the title is the deed to the property. So you can have somebody, you can add somebody to the deed and take them off the deed, but you can't add somebody to once you've got the loan, you can't add somebody to the loan and you can't pull them off. What you have to do is you have to refinance. And so if you didn't qualify the first go around without that person, then you've got to make some kind of changes to be able to qualify when you refinance to take them off.
Awesome.
Does that make sense?
Awesome. Understood.
What was the last part? There's something else on there too, though.
Yeah. So they mentioned if they can add a third person to the loan.
Oh, how many people?
Yeah, how many people?
It's usually going to be limited to about 4 people.
4? Okay.
Yeah, on FHA, yeah.
Okay.
Conventional is probably going to be more like 3. Well, it comes down to applications too. You can put a husband and wife on an application, but one application, but you can't put non-married people on the same application.
Okay.
So if you and I were going to buy a house together, there'd be an application for me and there'd be an application for you. If Karen and I were going to buy a house together, we just go on one application.
Okay.
Yeah.
Perfect.
Yeah, but typically you're talking usually about 4 people.
4 people.
Yeah.
Awesome. 4 FHA and then conventional.
FHA and conventional too.
Okay.
Yeah.
Okay.
Now when you're getting into some of these other programs like the 1099, the Foreign National, the I-10, all that kind of stuff, they're probably going to be closer to like 2 people.
So they start kind of,
Yeah, these are already considered riskier loans. That's why they have higher interest rates. And when I say risky, what that means is they're more likely to default. So it doesn't mean that they 90% of them default. It could be like 3% default. But the thing is that they default more than conventional loans and FHA loans. So for the investors that are forking out that money, they want to get a better return because they know that they're going to lose some money on some of the deals.
That makes sense.
So it's already kind of a risky loan. 1 month bank statement. That's So that's why they'll have like a requirement for more down payment or maybe a higher credit score or whatever.
Yeah. Perfect.
Yeah, very cool.
I think that's it for this episode.
Yeah, very cool. We appreciate you guys joining us. We've got a new first-time home buyers guide out, and you can pick up a copy at showcasefreeguide.com. And we've also created a new channel on YouTube called Snacks TV, and that's where we take all of our long content and we break it up into little bite-sized pieces. And we combine that with our short content that we have on TikTok and Facebook and Instagram. And we've organized it into each of the 9 steps. So there's 9 steps to buy a house, and we've organized it. So we've just put that together. That might be a resource you'd want to check out. and you can go to it directly at snackstv.com, and you'll put the logo on it.
Yeah.
Because it's got a Z instead of a S.
URL. Awesome.
Yeah.
And then if you guys have any viewer questions, feel free to comment them down below. Also, please subscribe to our channel, give us a like, and also turn on your post notifications to see when we upload next.
Yeah, absolutely. Thanks for joining us. Hope you have an awesome day, and we'll see you next week.